Markets spring to life as tech leads, but uncertainty lingers. U.S. stock index futures jumped sharply as the market responded to a strong earnings report from Nvidia Corporation and turned its gaze toward upcoming employment data. Futures tied to the S&P 500 were up around 1.3%, while futures for the Nasdaq 100 rose roughly 1.8%. The gains were mostly tech-driven, with Nvidia's outperformance acting as a catalyst. The chipmaker's results provided fresh evidence that the AI investment story still has legs, giving investors renewed confidence after a period of caution around the overheated tech sector. But even though the mood is improved, several clouds remain on the horizon. The upcoming and delayed U.S. jobs report and ongoing debate at the Federal Reserve over interest rates are keeping some traders on edge. What is Nvidia's role in the rally? Nvidia, often viewed as a bellwether for the AI and tech investing boom, beat expectations on its recent earnings and gave a favorable forecast for the year-end quarter. Its performance is significant for two reasons. First, it signals that chip demand and AI infrastructure spending remain robust, which supports tech stocks more broadly. Second, it helps deflate worries that the AI sector had become a bubble about to burst. CEO Jensen Huang reportedly dismissed AI bubble fears, saying the story is very different. As a result, chip-related stocks and other growth names rallied. Companies like Advanced Micro Devices, Broadcom Incorporated and Marvell Technology saw gains. The jobs report and Fed moves, the wild card factors. Even though tech is leading the charge, the broader market remains sensitive to macro data and interest rate policy. The delay in the U.S. employment report, caused by the government shutdown, means that investors are extra vigilant. The data, when released, will impact expectations for rate cuts by the Fed. Currently, the probability of a December rate cut has fallen, as seen via tools like the CME FedWatch. For the moment, if the jobs data shows stronger than expected growth, it could heighten inflation fears and push yields up, which often pressures growth/tech stocks. If the data is weak, it may increase speculation of rate cuts, generally supportive of stocks, but also raise recession worries. Hence, the upcoming data is a critical test for the market's next leg. What to watch going forward? Keep an eye on the actual release of the jobs numbers and whether market expectations, in terms of payrolls, unemployment rate, get met, beat, or miss. Monitor guidance from the Fed and speeches from Fed officials, how they interpret inflation, labor market strength, and rate cut timing. Observe how tech and growth stocks behave if macro data shifts. Will the tech rally sustain itself even if rates stay higher for longer? Look at valuation and sentiment. Even with the rally, some analysts worry about stretched valuations among growth names and whether momentum can persist.